Hello, and thanks for joining me today. I'm Jim Davis with Aspen Wealth Management here in Fort Worth, Texas. This session, Tax Smart Retirement, Keeping More of What You've Earned, is designed for corporate executives approaching retirement who are facing increasingly complex financial and tax decisions. If you're wondering or asking questions like, can I retire? When should I retire? And how do I do it in a way that's actually tax efficient? You come to the right place. Today is purely educational. There's no product pitches or sales. Our goal is simple, and that's to give you clarity and a framework for the decisions that will matter most over the next 5 to 10 years before you retire. The decade between about 50 and 60 is often the most financially consequential period of your life. Income, taxes, equity compensation, they're all usually at their peak, while the margin for error is shrinking year by year. And the decisions you make or avoid during this window can permanently affect your lifestyle, your tax bill, and even your legacy. Most of the big retirement mistakes don't show up after you retire. They're created quietly in the years leading up to that big day. And that's what we're focusing on this stage, not just on what happens after your last day at work, but the years leading up to it, as you see here on the screen. For many of the executives we work with, the financial picture looks a lot like this. You're in your highest earning years. You might have multiple streams or types of compensation. You also likely have a growing stack of equity awards. Your tax return is also getting thicker every year, and it can feel like more of your hard-earned income is disappearing due to taxes. And at the same time, you may not have a clear definition of what retirement ready really even means for you. But that's not a failure. It's just a sign of complexity, and complexity often needs coordination. One of the biggest challenges isn't discipline or intelligence for executives or highly compensated employees. It's fragmentation. You might have a CPA doing your tax return, an advisor managing your investments. You may have HR or some business rep handling benefits. You also could have an attorney drafting estate documents or business documents. Each piece of advice these professionals give may be perfectly reasonable on its own, but if no one's coordinating it, you can end up paying more taxes or taking more risk, or maybe a combination of both. It's not uncommon for us to see a CPA recommending one thing for tax reasons and a prior financial advisor recommending something totally different for investment reasons, with no one accountable for the whole picture. And that's what we kind of call a financial junk drawer at Aspen. It's a lot of good pieces. Again, it's 401ks at prior employers. It's stock options held at another institution. It's maybe too much cash in the bank from RSUs that have invested and sold. None of these things in and of themselves are bad, but without being organized, they end up looking like a junk drawer. The role of a financial plan isn't to change necessarily all the parts, but to make them fit together. And once you do so, that's where you can see what efficiencies exist or maybe what inefficiencies exist as well. So here's how we're going to spend our time today. First, we're going to look at equity compensation planning, how RSUs, stock options, and others affect both taxes and your retirement readiness. Second, we'll talk about concentrated stock, how employer stock risk builds, and how to manage it thoughtfully. Third, we'll cover critical employer stock decisions at retirement, including a strategy called net unrealized appreciation, or NUA. Finally, we'll take a look at tax smart retirement planning overall and how to use these key planning windows around retirement to improve your outcomes. So first, let's start with equity compensation planning. Equity compensation can be an incredibly powerful wealth building tool, but it's also one of the most misunderstood areas for executives approaching retirement. How these awards are structured, how you act on them, how they can have a meaningful impact on your taxes, your portfolio, and even your retirement income. There are three main types of equity compensation that we see most often. The first are restricted stock units, or RSUs. RSUs are shares granted to you that typically vest over time. When they vest, the fair market value of the shares is taxed as ordinary income, just like a salary, and your employer usually withholds some of that for taxes. RSUs are really attractive because they're relatively straightforward, but they can create concentration risk if you hold on to them long-term or over time. Then we have stock options, and there's different kinds, but there's really two main types of stock options. and that's incentive stock options or non-qualified stock options. Incentive stock options can provide like preferential tax treatment if certain holding requirements are met, but they can also trigger this thing called an AMT tax in some cases. Non-qualified stock options, they can be taxed as ordinary income when they're exercised, and those, if you're not careful, they can significantly affect your bracket. Timing your exercise decisions with these options is critical so that you can minimize the tax impact and integrate that planning with your overall financial or retirement plan. The last one we can kind of touch on are employee stock purchase plans, or ESPPs. These are great tools, and they actually allow you to buy company stock, oftentimes at a discount, through payroll deductions. The same way you see health insurance or dental or vision or 401k savings taken out, you'll see that you get a little piece of your income sliced away where you get to actually purchase company stock, sometimes at a 12 to 15% discount. These can create additional taxable income, especially if shares are sold immediately after purchase, but they also offer capital gain opportunities if they're held the right way. The key point here is that these equity awards are rarely just investments. They are tax and retirement planning decisions as well. Anytime you put money into any one of these devices or are awarded any of these devices, yes, they are investments, but they're also tax decisions. Each type behaves very differently. And when combined with your salary, your bonuses, and other holdings, the cumulative effect can be really significant. Making tax-smart decisions about equity compensation can help reduce risk, preserve flexibility, and support your long-term retirement goals. So what are some mistakes we see? The mistakes we see around equity compensation are rarely dramatic. They're subtle, and that's what makes them dangerous. One common issue is letting RSUs vest automatically year after year without stepping back to evaluate whether that still makes sense. When RSUs vest, they create ordinary income that stacks on top of your salary and your bonuses. Often, withholding isn't enough, which leads to surprise tax bills. At the same time, those shares quietly can increase in concentration in employer stock. It's not uncommon for us to get a wave of kind of inquiries to our firm or questions at our firm about taxes around tax filing when people start getting RSUs and they're not used to them, because they go from either owing a little or maybe getting a little refund to a surprise bill that also has maybe penalties or interest alongside of it. A very common scenario we see is RSUs vesting in the same year as a large bonus or other liquidity event. And on paper, nothing went wrong. But again, the tax impact is far larger than expected. Another mistake we see is exercising options based on the stock price without considering the timing for tax purposes or the retirement implications. And these aren't mistakes made by inexperienced people. They're often made by very successful professionals who simply haven't had a reason to slow down and reassess their stock options until now. One reason these mistakes persist is that equity compensation doesn't feel like income in the same way a paycheck does. When RSUs vest or options are exercised, the tax impact often shows up months later when the tax return is filed. Again, let's say you get a mid-year award of stocks. Well, you don't typically file your taxes until maybe the spring or maybe the following summer if you extend, right? So when RSUs vest or options are exercised, the tax impact shows up later, but by then the decision is long past. What really matters isn't just this year's tax bill, but the pattern being created over the next 5 to 10 years and the compounded effects of those decisions. And again, not making a decision is a decision of itself when it comes to stock options. And these repeated decisions, even small ones, they compound over time. And by the time retirement is close, by the time you can see it and the light's kind of at the end of the tunnel, reversing those decisions becomes much, much harder. So now let's talk about concentrated stock risk. Again, this is something that usually builds slowly and almost invisibly. Over time, RSUs vest, options are exercised, ESPP shares accumulate. And before you know it, a large share of your net worth and your paycheck are tied to the same company. This isn't about pessimism or a lack of confidence in your employer. It's just about recognizing that a single stock has far more risk than a diversified portfolio. As retirement approaches, you simply have fewer years to recover from a negative surprise, which makes concentration much more dangerous than it feels. I do love this image on the screen here because, as you can see, from 1927 to 2024, the average annualized return for these stocks over the 3 years prior to joining the top 10 largest companies on the US stock exchange was more than 25% higher than the market. I mean, these things, before they become the 10 biggest, they grow at a much higher clip than this traditional market does. However, once they make the top 10, okay, as you can see here, 5 years after joining the top 10, these stocks were, on average, underperforming the market, just a stark turnaround from before. And we see this all the time with companies or employees who have a highly concentrated positions in a growth-oriented company. This is another illustration to kind of highlight a similar point. History gives us a useful reminder. Even the biggest, most admired companies rarely stay on top forever. If you look at the largest companies in the market over time, the roster changes dramatically from decade to decade. Since 1980, only 3 of the 10 largest companies were still in the top 10 by 2000, and none are there today. And technology dominates the market now, but in 1980, 6 of the 10 largest companies were in the energy sector. Even major technological shifts don't consistently reward the same companies or industries indefinitely. Now, that doesn't necessarily mean your company is destined to struggle, but it does mean that betting on your retirement on any single stock, no matter how strong it looks today, can be risky. Familiarity and personal success with a company can make that risk feel smaller than it actually is. Diversification is the tool that lets you participate in today's leaders while still being positioned for tomorrow. So how do we manage this risk? We've got all our eggs in one basket and we want to unwind it, or maybe we want to plan thoughtfully about not having all of our eggs in one basket. Managing concentration risk doesn't mean selling everything tomorrow. In most cases, it's a thoughtful, phased process. It might include spreading diversification over multiple years. It might be coordinating sales with tax loss harvesting or aligning diversification with charitable goals. For one of my clients who's going to be retiring this year, we kind of have a 4 to 5 year roadmap for how we can unwind his company stock over time. There's no one strategy that eliminates risks and eliminates taxes at the same time. The goal here is to make intentional trade-offs rather than accidental ones. One of the most effective ways to do this is to establish a decision framework. Instead of asking, should I sell now? A better question is, what percentage of my net worth am I comfortable having tied to one company for 5 years from now? And from there, decisions can become more objective. Okay. A good rule of thumb sometimes we tell folks is never have more than 5% of your net worth in one single company if it can be prevented. Another way I like to help clients think about this and about holding a specific stock is, what would you do if you were given a blank check to invest? For example, if I was to give a client $25,000 or $30,000 and they had to invest it, would they buy $25,000 or $30,000 of their company stock? Or would they buy an S&P 500 fund? Again, you may say yes to either one of those or no to both, right? But it's important to think about stock options in a similar way. Would you buy more of your company stock, or would you invest in something different if you were handed an amount of cash to do so? This is another example of tax-smart retirement planning. We're not avoiding taxes at all costs, but we're managing risk and taxes together. The third area is about critical employer stock decisions at retirement. Okay, you've got these windows of time in your careers where you can actually capitalize on stock that have built up in certain types of accounts. So on this slide, you see here this technical term called net unrealized appreciation. Okay. Some people call it NUA, as you see here. I want to briefly explain NUA in plain English. When you hold a company stock inside of your 401k plan, there are two key numbers to monitor. The cost basis, that's what you paid for the shares, and the current value, what they're worth today. The difference between those amounts is the net unrealized appreciation, or NUA. Normally, if you just roll everything to an IRA, every future dollar, as you see here, that comes out is taxed as ordinary income. NUA is a special rule that can let the growth on employer stock be taxed later at long-term capital gain rates instead. So here's a very simple example. If your company stock in your 401k is worth $200,000, and the cost basis, or what you paid for that stock over time, is $50,000, the $150,000 difference is your net unrealized appreciation. With an NUA strategy, you might pay ordinary income tax on the $50,000 of basis, again, what you paid for now, and later you can actually pay capital gains on the $150,000 of growth when you sell. So the big idea here is, for some people, NUA can turn part of what you have been given at ordinary income into a retirement in the capital gains brackets instead. But it's important to note that it is a one-time, hard-to-reverse decision, and it keeps you exposed to that stock. So it's something to analyze carefully with your tax and planning team, not something just to do on your own or on a whim or by default. NUA, or net unrealized appreciation again, can be a powerful tool when several conditions line up. The stock has significant appreciation, you got a clear path to diversify afterwards, and the move again fits within an overall broader tax strategy. In those situations, you may be able to shift some of the growth from ordinary income rates to capital gain rates, which are oftentimes much lower for retirees. On the other hand, if NUA keeps you heavily concentrated in one stock, or it doesn't fit within your long-term plan, the portfolio risk can easily outweigh the tax benefits. NUA itself, just like any other planning-related item, isn't inherently good or bad. It's simply a tool. Whether it's tax smart or not depends entirely on the rest of your balance sheet, your time horizon, and the planning you've done with a tax professional. The final area we're going to talk about here is tax smart retirement planning. And you've heard me kind of belabor this point or use it quite a few times so far in this presentation. Most people think about retirement mainly as a market-related problem. Will my portfolio earn enough? What's the rate of return I'm getting on X, Y, or Z? But taxes are often one of the largest expenses people have in retirement. The difference is that taxes in retirement are harder to visualize than market returns. Market performance is visible. You can log in and see your account go up or down or anywhere in between. But taxes are cumulative. They're more gradual and they're quiet. No one really looks every day and checks your tax balance that you owe the IRS. It's just not how they operate. But for higher income retirees with large pre-tax balances, again, these are 401ks or maybe IRAs, taxes can be just as important as market returns. Large traditional 401ks and IRA balances mean future withdrawals will all be taxable. And as you see here on the screen, once required distributions start, oftentimes it's for people in their 70s, like early to mid 70s, once those kick into gear, those withdrawals are no longer optional. RMDs can push you into higher tax brackets. It can increase the taxation of your Social Security benefits. And it can also trigger higher Medicare premiums. What we see here is called IRMA charges. Two retirees with the same net worth can have very different lifestyles simply because one planned proactively around taxes and the other did not. We kind of internally in our firm will call these folks like 401k millionaires. I've told this story to clients before, but one of my clients was a very successful doctor. And he had the fortune of kind of amassing a really large pre-tax 401k. He started early, he bought good quality investments, and that thing just grew over time. Now, he had a little slug of money in cash, checking and savings, and everything else was in his 401k. That's where him and his wife decided over the years to invest their money. But while he was still working in his late 50s, his daughter was getting married. We're so excited. He calls and says, "Hey, Jim, I've got a wedding I want to plan for." And so we kind of started talking about the budget. I said, "Well, Dr. Joe, what was the budget you and your wife were thinking about?" So he told me the number, and knowing what they had in cash and what their cash flow was, I realized a large part of his wedding had to be paid for out of a 401k plan or pre-tax dollars. Okay. When that realization occurred, while he's in his prime earning years, we realized this distribution was not going to, be a 10 or 12 or 20% tax, but he's in his prime earning years, needing to pull off pre-tax dollars. So for every dollar he spent, he actually had to spend about 30 to 35% more of that just to cover the tax bill for that distribution. He was also about to turn on Medicare. And this kind of ripple effect meant that his premiums are going to be a lot harder and a lot more expensive down the road. So this decision to save and save and save in a 401k, while it's good to have retirement savings, it would have been much more prudent for him to have been redirecting money into a non-retirement account in the years prior to kind of avoided this big tax bill he was going to incur. And this is why early retirement tax planning is so important. It's not about what you have, right? But it's about what you keep. So as you see here, there is often a window between retirement and the start of Social Security and RMDs when your income is lower and more controllable. This period can create opportunities for strategies like partial Roth conversions. We've done webinars on that. Capital gain or loss harvesting. A lot of people hear about tax loss harvesting, but you can do capital gain harvesting as well. Or maybe shifting to where you draw your income from. We see many people glide through the years without realizing how much flexibility they had until the window is closed. Because once Social Security and RMDs kick in, you lose a lot of the ability to decide when and how income shows up on your tax return. The goal is to be proactive in this window, not reactive later when your options are limited. So as you see here, what we see is an illustration of someone who maybe has a few years left of retirement. Again, those kind of blue lines represent income. They retire, and then somewhere down the road after 2036, required distributions start. So what we would recommend, not every client, but a lot of clients do, is if they've got the right buckets of money, pre-tax, after-tax, maybe Roth, cash, things of the like, we would establish a systematic withdrawal plan that pulls on pre-tax assets up to certain marginal rates, that pulls on capital gains brackets up to certain marginal rates, to use Roth funds when necessary to make sure you don't go over a certain tax threshold. Using a dynamic, coordinated approach to withdrawal planning is oftentimes how you mitigate those required distributions and subsequent taxes down the road, all of which kind of tie into stock options, depending on the accounts they're held in. So why does this coordination matter? Now you can see why none of these decisions truly stand alone. Equity decisions about stock options, they affect your tax exposure, which can then affect your retirement income, which can then affect your Medicare premiums, and even the taxation of Social Security. These cash flow realities then feed directly into your estate or your legacy planning goals. And if you optimize one area in isolation, for example, investments, while ignoring taxes or your estate plan, the overall result can actually be worse, not better. That's why we encourage folks to focus on coordination, developing an integrated strategy, instead of, again, this junk drawer or this amalgamation of separate decisions in and of themselves that may not be bad, but if not made well together or in a coordinated fashion, can be really efficient down the road. So how would we view or assess a financial plan? Where do stock options fit into this equation? When we talk about stock options or equity compensation, as you see here on the screen, they come out of your cash flow and your budget. They find their way into your investment portfolio. And somewhere in transit, they trigger a tax bill. And depending on what the net proceeds are after taxes, that impacts, again, your investments, but also your retirement plan. And so it's important to see how all these things are integrated together. We consider this framework at Aspen called a financial future framework. We would recommend that you pull together tax planning, retirement income, investments, estate and legacy goals, risk management, and most importantly, cash flow into one coordinated financial plan. Every decision we've talked about today, equity compensation, concentration, NUAs, Roth conversions, these all touch on multiple parts of this framework. Because in our experience, most executives aren't looking for more information. They're looking for someone to own the integration and help them make confident, aligned decisions over time. Our role, and the role we believe a financial planner should play, is to be that single point of coordination or that quarterback to help you make decisions that are working together instead of against each other. So I would like to leave you with a few takeaways from today. First and foremost, equity compensation is too important to leave on autopilot. It deserves active planning around both taxes and risk. Second, concentrated stock risk tends to grow quietly, and it's best managed intentionally, not in a rush right before retirement. Okay? Third, retirement brings irreversible tax decisions, especially around employer stock purchase plans or employer stock in general, as well as large pre-tax balances. So early planning matters. One metaphor we like to use all the time when it comes to planning for retirement is it's cheesy, but it's about the movie Top Gun. In the first Top Gun, the original, the best Top Gun, in the opening scene, the main character Maverick is helping his friend Merlin trying to land a plane on an aircraft carrier. And when you've got a really short runway, the margin for error increases exponentially. Okay, you don't have the ability to afford making a bad decision when the runway is as short as it is. However, if you are 5 to 10 miles out from said destination or some runway, you've got some wiggle room. You've got some adjustments you can make. Even minor adjustments can make major changes to your course over a long-term stretch. Retirement planning isn't too dissimilar. The sooner you get ahead of this stuff, the sooner you get a plan put together, the better opportunity you put yourselves to be in a proactive stance rather than in a reactive posture when it comes to planning for retirement. So if you'd like to see how these ideas apply to your situation, like upcoming vesting events, NUA decisions, or a potential retirement date, we're happy to have a conversation and walk through what a plan may look like for you. Thank you again for taking the time with me today to go over this information. If today raised questions or you'd like a second opinion on your equity, your employer stock, your retirement plan, you can reach me directly using the information on the screen. You can also visit our website or you can use the QR code that you got in your mailer for a brief introductory call. These conversations are designed to be educational and exploratory. There's no pressure. We're just trying to help you gain some clarity in your situation. We look forward to helping you design a retirement that's not only financially secure, but tax efficient. Thank you.